I'll share 8 lessons that I wish I'd known about stock investing when I started about 6 years ago. Knowing these would have saved me a lot of money and avoided emotional stress. Hello finance people, my name is Robert and I'm here to share my learnings and experiences about personal finance as a European. So the first lesson is probably the hardest to put into action. I mean, I still struggle with this whenever I have a decision to make to invest or not to invest. So let me ask you a question. If you look at this graph, would you buy the stock? This is about 10-year time frame and you can see it's gone from about 78 to 300. That's about 380% increase. So would you buy it or wait for it to come down? Now, just by looking at this graph, you will probably say, just wait. It's at its highest peak and it's just not sustainable growth. It must crash at some point. What about now? Would you invest into it now? So you already missed out on quite a rise here. Would you invest now? And now, you kind of missed out the whole ride. I mean, we started somewhere here and it has at least tripled from there. This growth is pretty crazy. It looks like it's completely unsustainable. So let me show you. This is actually S&P 500 graph. And you can see that we started like in the 90s. We went from, what is this, like 300 and now we're at 4,200 or 300. Do you see the problem? Picture this, you are at a carnival standing before a whack-a-mole game. You've got a hammer and you're trying to predict which mole will pop up next so you can smack it before it comes out. That's a bit like trying to time the market. Just when you think you've got it figured out and boom, another mole pops up somewhere unexpected. And either you missed the opportunity or you were too early. And now I'm not just making this up that timing the market doesn't work. Some of the brightest minds in investing have weighed in on this topic. Warren Buffett, the Michael Jordan of investing, he once said the stock market is a device for transferring money from the impatient to the patient. So if you're holding on to lots of cash waiting for the next big crash, remember that the market is unpredictable. As the old saying goes, it's not about timing the market, but the time in the market. And this takes me nicely to the next point. Suppose you see something like this. I personally get a bit uncomfortable to invest since we are at the all-time high. And this growth, I mean, it's just insane. This cannot be sustainable, right? I mean, look at it. But here's the trick. Now, pretty much any graph that is connected to finance has this, but they're usually hidden in settings. So if you go to settings, from here you can choose logarithmic. Now you can actually see, wait a minute. The growth has been quite steady for basically from the 50s. So the unsustainable growth, it just looks in the graph because this graph is logarithmic and the one that by default is linear. The problem with linear is that, let's say it doubled from here to here. Okay, fine. But if you double from 3,000 to 6,000, you actually occupy 2 squares like this one here. And this one occupies only 1. So you don't actually see in this graph that it doubled. When you look at linear graphs, you'll notice that here we don't even know how much. It looks like it's insignificant results here, how much it rose here. But actually it might have doubled here and we wouldn't even see it because it's so small. It occupies very small area just because it needs to show the same distance for every 1,000 euros or dollars. This is the problem with linear graphs. Whereas with logarithmic, if you come here, they actually show you see here on the right hand side, it went from 140. 140 looks this much. This is quite a lot, right? So from 140 to double, that's 240. So it will be somewhere here. From 240, if we go double, that's 400. What is that? 480. So 480 would be here. So you can see that it gets squashed the closer it gets to the top because then the differences are the same. So it's not because of the graph that it looks like exponential growth. It's because it's actually happened exponential growth. And looking at logarithmic charts is the second lesson I wish I had known before I started. Now, I have a dedicated video where I explain how the logarithmic graph works. You can just click on this video banner. But in summary, use logarithmic graphs when looking at long time periods because it gives you a more realistic picture of the growth or decline. Now, the next lesson is so unsexy, especially if you are in your early 20s, but it's the one that will bring you most satisfaction and mental peace. I have a great hypothetical scenario from Schwab.com where Peter and Matthew each received $2,000 at the beginning of every year for 20 years and both S&P 500 index which consists of the 500 biggest public companies in the US. And this is just used as benchmark for the US economy overall. So Peter was a perfect market timer. He had incredible timing and was able to place his 2000 into the market every year at the lowest closing point. For example, Peter had the 2000 to invest at the start of 2003 rather than just putting it immediately into the market. He waited and invested on March 11, 2003. That's the year's lowest point for S&P 500. Then at the beginning of 2004, Peter received another $2,000. He waited and invested the money on August 12, so almost half a year he waited, and that was the lowest point of the year. He continued to time his investments perfectly every year until 2022. Then we have Matthew, who divided his annual $2,000 into 12 equal portions, which he invested at the beginning of each month. This strategy is known as dollar cost averaging, or since I'm in Europe, for me it's euro cost averaging. Okay, so let's take a look at the results of this. Obviously, Peter won. He was perfect. He timed it perfectly. But what's incredible about this is that Matthew is not that far behind, because let's face it, it's hard enough to time the market 3 years in a row, but 20 years, very, very low chances. So that's my third lesson. When investing in ETFs that are usually a bit more stable than individual stocks, then dollar cost averaging is the way to go. It's like setting a steady pace in a marathon instead of sprinting and burning out. By investing a fixed amount regularly, regardless of the market situation, you're kind of smoothing out the highs and lows over time. But we're just assuming that the market will grow, in the long term, that the market will always grow. Now, I get it, this might not win you the most exciting investor award, but trust me, it gets exciting when your money works for you. And since I get super emotional about money and investing, it's a lifesaver. I don't need to think about it every month because I can automate it. I can just send my money from my bank account to my investment platform and set recurring investments. This way it's out of my hands and I need to make less decisions. If you're interested in setting up Euro cost average and automating your investments, then check out this video here where I'll show you step by step the best way to do it in Europe. Remember when a few years ago Bitcoin had a huge spike in price? It went from like 8,000 to 50,000 in a matter of few months. During this time, I was talking to my mom, who was in her late 50s at the time. Out of nowhere, she said, "Hey, Bitcoin has grown. Do you think I should buy it?" I mean, my mom had a FOMO for something she doesn't even understand. And I don't blame her. I felt the same way, and a lot of people did that too. But the moral of the story is that we make a lot of financial decisions based on emotions, be that FOMO, fear, greed, or just following the herd. And Benjamin Graham, who's often called the father of value investing and was Warren Buffett's mentor, summarizes it well. The investor's chief problem and even his worst enemy is likely to be himself. And that's basically my fourth lesson. Don't invest with emotions. Basically, we need to develop the discipline to act rationally and detach ourselves from our emotions when investing. That way, you're less likely to panic during market downturns and more likely to see them as regular parts of the journey. But okay, that's easier said than done. How do you do it? Well, what has helped me is consistent investing. As I already mentioned earlier, setting overall strategy, that helps. For example, my overall strategy is not to get rich quickly, but to build wealth at a steady 7 to 8% yearly when looking over a decade or so. And the most significant thing is not to lose money. And I'd instead go for smaller risk with smaller reward than do a YOLO investment. So you only live once. Now, when I started investing, I was following a lot of finance YouTubers and so-called experts. I was learning a lot from them in terms of how things work. Then occasionally they would give predictions about how the market would do in the short term. And I actually acted on these predictions. Bought a stock here and there and maybe some crypto. But as you can guess, it didn't end up that well. Maybe I didn't have the financial literacy, but these experts probably just can't predict the future. Sir John Templeton, a legendary investor, warned us by saying the 4 most dangerous words in investing are, "This time it's different." So whenever you stumble upon a claim that's too revolutionary or seems to rewrite the rules of finance, a healthy dose of skepticism might be your best friend. Many experts, even with brilliant track records, don't always hit the mark. It's been studied multiple times, especially about complex systems like stock markets, go wrong as often as they go right. I mean, they can't even predict the weather right now, so do you think they can predict stock market? I've even created this finance YouTubers versus S&P 500 index graph. As you can see, these people love to create a fuss, but how well do they predict things? Well, let's say if you predict a crash every month, at some point you will be right? So basically that's my fifth lesson. Don't act on the expert opinions. Do your own research or just stick to your strategy, the initial strategy you set. For an in-depth video about financial YouTubers versus S&P 500 index, click on this video banner. I'll compare how your investment would do if you listen to YouTubers over just investing in S&P 500. And I created nice graphs and I have a few scenarios there, so check it out. Ever heard of the saying, it's not about how much you make, but how much you can keep? This is especially true in investing. Let's start with a real-world scenario. Imagine you have 1,000 euros and you suffer a loss of 50%. Now you're left with 500. That's simple, right? To get it back to your original 1,000, how much does your stock need to increase? 50% gain, right? Not exactly. You need actually 100% gain, because 50% gain will get you only to 750 euros. Crazy, right? This principle is emphasized by the oracle himself, Warren Buffett. He said the first rule of investment is don't lose money. And the second rule of the investment is don't forget the first rule. What he's hinting here is the uphill battle you face when trying to recover from losses. That's why it gets a bit more complicated, because our psychology kicks in. Humans are wired with what's called loss aversion. We feel the pain of losses roughly twice as intensely as the pleasure from gains. This means a 20% dip in your portfolio might upset you twice as much as a 20% gain would make you happy. So the sixth lesson today, losses are harder to recover. You need to keep in mind the asymmetry between losses and gains. But it's not just about numbers, it's about the mental game too. So guard your investments and play it smart. Okay, as we trade in Europe and often buy assets that are either in dollars or they use dollars as base currency, that means we need to take that into account when investing. Let me show you an example. Here's my September portfolio update. You can check the full video by clicking on this video banner here. But basically I have here VUSA, which tracks S&P 500. But you can see that S&P 500 dropped by almost 5%, but VUSA only by 2.5%. That's pretty strange, right? I mean, they should just, be correlated. They should follow each other. And this is because of currencies. VUSA base currency is in dollars, even though I buy the asset from European exchanges in euros or pounds. But the asset itself is kept in dollars in this case. And since the euro has weakened against the dollar, that means with every dollar you can get more euros. This is why VUSA has dropped less than S&P 500. The stronger dollar offsets the drop. In this case, it benefited me, but sometimes it might go the other way. This is called currency risk, which is my seventh lesson. This is relatively small risk, but something to keep in mind when dealing with different currencies, because currency risk has an impact on your results overall. And the last lesson I want to share with you is that I think investing is just a defensive move. My goal with investing is to preserve wealth. It is not an effective wealth creation tool unless you already have a lot of money. Because let's face it, who wants to wait 40 years to be rich? To get to your goal faster, you need to play offense by making more money. That's why I've created this video here where I'll talk about 5 commandments of wealth generation, and it all starts with the right mindset. So it's not so much how to make it, but the right mindset to make it.